Hi, this is Jeng, and I want to give you an update on multifamily financing, where it stands sort of July 2020. So there's really four main types of loans that you can get when you're out there financing multifamily. There's bank loans, there's Freddie Mac SBL, there's Fannie, and non-recourse bridge. And so let's just jump into all of them and talk about rates. So on the Fannie side, we're seeing rates sort of low threes for majority of the product, and you can get under three if you drop below 65%, and this is for loans over $6 million. Probably add 30 to 40 basis points if it's under 6 million on the Fannie side. On the Freddie side, you're sort of low fours is what we're seeing most of the product price for, especially if you're going with the declining prepay on the Freddie SBL. On life company CMBS, we're still seeing very limited activity sort of in retail, hospitality, office. Most deals are just going for apartments and industrial. You're still able to get quotes on most of that stuff, but most of the life company stuff is going to be higher quality, sort of your class A stuff in most markets. So let's talk about Fannie. This is where we do a lot of business. They are, they're seeing forbearances slow down. In April, it was close to just 29 loans. Now in May, it jumped up big time, 229 loans. June is slowed down 267, and then July is only 271. So they're seeing that slow down, but they did actually extend forbearance options for people. So if you took the forbearance and you need additional time, they're giving you 3 additional months, and you have 24 months to pay that back. So I don't think we're going to see any of these distressed loans come up right now as they continue to give more forbearance to these owners. But in the new forbearance, you still have the same restrictions that you had in the old one. So unless you really need it, I would not recommend going out and getting forbearance. If you can make your payment, then keep making your payment. In terms of Freddie Mac, so they came out with additional information as well. They're a little bit more detailed in what they give you. So about 4% of their loans are in forbearance, which is up slightly from May, only 178 more loans than May. A lot of the Freddie loans on the small balance side are in forbearance. So 75% of the loans come from the small balance side, which is sort of that 1 million to 7.5 million. And these are typically B and C properties, but they're smaller, right? So they're 50 units, 60 units, or even lower, and they have more hourly workers. And so a lot of those businesses have been shut down. They just haven't come back as strong. And then there's also one thing in the article that they talked about, like sort of in your, I would say, New York, Chicago, those places where the commercial income makes up let's say 5-10% of the overall revenue. That's essentially zero for the last couple of months. And so that is hitting them on top of it being, let's say, a 5-unit or 10-unit property in New York. So all those things are coming together where a lot of the loans that Freddie has on the small balance side are forbearance. And then a lot of the student housing and senior housing as well makes up close to 20%. So students, 9% of the loans are student and 11% are senior. So as students may or may not go back in the fall, and then senior housing, just with COVID hitting that population a lot harder, it's been harder to lease those properties up and even stabilize properties on the senior side. And they as well are giving new forbearance options. They're extending it another 90 days. They're extending the repayment, their period as well. And then you still have the same restrictions though. So if you get any of these additional forbearance options, then you're not going to be able to evict tenants. You're not going to be able to charge late fees, and you have to be flexible with your tenants, right? So Freddie's being flexible to you, and you need to be flexible with your tenants. So here is the latest and greatest on the reserve requirements. And so, on, let's say, conventional loans, so 6 million and higher, you're really at 12 months on 80% levered deals. It drops down to 6 months P&I if you drop below 65% and 135 cover. And both of those are released after 9 months. So 6 months of waiting period. And then that last quarter, they're going to test it for either 125 at the higher leverage and then 135 at the lower leverage. $6 million and under on Fannie. If you go down here, you're at 18 months P&I, and it's also going to be released after 9 months. And then if you drop to 65% loan to value, it goes to 6 months P&I. It's released after 9 months as well. And remember, if you do an assumption, there's no reserves, but if you do that assumption supplemental, then the reserves are going to be based on the total loan amount and debt service requirement. Flipping over to Freddie, let's start on the SBL side. Still 12 months P&I, and this is going to be released after 90 days or after they drop all the declarations of stay at home, and that's been released for 90 days. All your due diligence in terms of, let's say they didn't do an inspection or anything like that, then that needs to be complete, and then you need at least 80% occupancy for the prior 3 months, and they're going to give you a number in terms of release rental collections, and that's usually going to be like your T3 number that you underwrite at close or before closing for the loan. Freddie conventional 9 months P&I. If it's less than 140, if it's above 140, then 6 months P&I. Similar release provisions for Freddie. And so I thought this would be interesting just to show you. This was from a loan that we did in the last month or so. And it basically just adds in a portion to the loan agreement saying, look, these are the things that we would normally do: appraisal, lender inspection, engineering report. If those have not been received for whatever reason, then we're going to need that within before this reserve is released. And then they're also going to put in, all right, here's your debt service reserve deposit right here. And then these are going to be your collections. So you're going to know exactly what your number needs to be in terms of monthly rental collections. And then you also need the occupancy of 80%. So once you hit that, you're able to, the first thing that they're going to do is they're going to look at, all right, have all the federal, state, and local emergency declarations been lifted for at least 90 days, and then, or it's already been 12 months. So the longest they're going to hold this is for 12 months, and then they're going to do your quarterly test. And then once they do the quarterly test, then that's when they're going to really look at those release provisions to see if you have been hitting them and your occupancy is above 80. If you are, then you're good to go, and they're going to release it to you. If for whatever reason you don't hit it in that, after 15 months, they're going to actually push it into your capital replacement reserve. So this is sort of like your capital account that you can draw upon after doing CapEx. You can draw upon that. So you just won't get the money back immediately, but over time you can get it back. So, my background was born and raised in Houston, went to school in Austin. I was a loan underwriter at G Capital, and then the last 5 years have originated close to $800 million in multifamily loans, and also invested in 21 properties across DFW, Austin, and San Antonio. So if you have any questions, definitely reach out to me. If you like this channel, definitely subscribe, like the video. And if you need help with a term sheet for a loan, whether you're refinancing or buying a property, or you just want me to review your deal, send it over. I need the T12, rent roll, OM, or investment package, and then we can set up some time to talk. Thanks a lot, guys.